Welcome back to the Deep Dive. Today, we're tearing open the books on Constellation Brands, ticker STZ. We're digging into their Q2 fiscal year 2026 earnings call.
Yeah, and this was a really important one. Came out pre-market. And, the whole consumer staples sector is kind of holding its breath right now about demand.
Absolutely. So our mission today is to get past those headline numbers, figure out what the real strategic picture looks like.
Right. I mean, STZ executed well this quarter, no doubt. But the big question, the real tension, is whether management's confidence holds up against, well, a pretty challenging volume picture with consumers pulling back.
Okay, let's start with the good news then. The stuff that got the market moving initially. They beat estimates.
They did. The non-GAAP comparable earnings per share, that's a number everyone watches closely, it landed at $3.63. Consensus was more like $3.37, so a significant beat there.
And revenue too, right? Came in slightly ahead.
Yeah, $2.48 billion versus the $2.46 billion expected. So, on the surface, looks pretty good. The execution engine, it seems, is running smoothly. Cost control, pricing power, it's there.
There's always a but, isn't there?
There is. That $2.48 billion in revenue is actually down 15% compared to last year. 15%.
Oof. Okay, so how does that square? Beat estimates, but down double digits year over year.
Volume. You got to look straight at the volume data. Beer depletions, that's what people are actually buying off the shelves. They were down 2.7% year over year.
Okay, 2.7% down. Not great, but maybe not catastrophic.
Well, then look at shipments. That's what STZ sells to their distributors. Shipments plunged 8.7%.
Whoa, okay. 8.7% down on shipments. That's a big number.
It is. So the core takeaway here is, yes, STZ is managing costs. They're managing pricing effectively, but they're doing it while facing a pretty severe slowdown in how much beer people are actually drinking, or at least buying.
And that operational skill, that discipline, is probably why they felt comfortable affirming sticking with their full-year comparable EPS guidance, right? At $11.30 into $11.60 range.
Exactly. That was the signal from management. Look, we see the soft volumes, we get it, but we believe we can execute our way through this turbulence.
It's worth noting, though, they did trim the reported EPS guidance slightly, cut it to $9.86. $10.16.
Right. And that seems less about the core beer business performance and maybe more about, ongoing portfolio cleanup, particularly in wine and spirits. Some noise there.
Okay, but those softening volumes, they had to acknowledge the weaker sales outlook somehow.
They did. Enterprise organic net sales guidance, that got trimmed. Now looking at a decline of 4% to 6% for the full year.
And the core beer business.
Beer is now expected to contract between 1% and 4%. So yeah, they're admitting the pressure is real. And that, brings up the big strategic tension point we were talking about, capital allocation. How are they spending their money? Despite cutting the sales outlook, they're holding firm on their free cash flow target, still aiming for $1.3 to $1.4 billion for the fiscal year.
And they're still buying back stock.
Oh, yeah. Over $600 million spent on buybacks just through September. They are definitely acting like a company that believes this downturn is temporary, that growth is coming back.
So that brings up the question everyone must have been asking on the call. Why aren't they pulling back on CapEx then? Capital expenditures.
Right. You'd think with softer demand, you might tap the brakes on spending.
Exactly. They're holding this massive FY26 CapEx target around $1.2 billion, and $1 billion of that is just for beer. Isn't that, a bit stubborn given the volumes?
Well, management's perspective is that this isn't just spending, it's essential investment. It's for long-term category dominance. Most of that money is tied up in things they already committed to, longer lead time items for building out capacity down in Mexico.
Ah, okay. So it's about the long game. Protecting the supply chain, the cost structure for their really profitable beer business down the road.
Precisely. Pulling back hard now could actually hurt them more later if or when demand snaps back. It's definitely a confident bet on the future, even if it adds some risk right now.
Did they give any indication they might slow down later if things don't improve?
They did acknowledge that. They confirmed they are actively looking at ways to maybe slow or avoid some CapEx spending beyond fiscal 26 if the environment stays soft. So not completely ignoring the present.
Okay, committing $1.2 billion now when volumes are falling. You only really do that if you fundamentally believe the problem is temporary, right? That it's cyclical.
And that brings us right to the core debate on the call. Is this weakness cyclical, tied to the economy, or is it something deeper, something structural or secular changing in consumer behavior?
What's management's take?
overwhelmingly cyclical. They kept pointing to macroeconomic anxiety. They have these monthly consumer studies, and apparently 80% of people surveyed Hispanic, non-Hispanic, across the board are worried about the socioeconomic situation.
80%, wow.
Yeah, and 70% specifically worried about their personal finances. The argument is when people are worried about money, they cut back on discretionary stuff, maybe trade down, or just buy less premium beer.
They also make a really specific point about timing, didn't they? Relating to their core Hispanic consumers.
It did. It was quite specific. They highlighted a sharp drop-off in sales volume around March and April this year, especially in certain pack sizes popular with Hispanic shoppers.
And they linked that directly to
Increased ICE activity. Their claim was that this activity suppressed sentiment and spending among that key demographic right at that time. It's a very sociological explanation for a financial trend.
So their story is it's the macro environment, maybe amplified by specific events, that's hitting volume. It's not that people suddenly don't want Corona or Modelo anymore.
That's the narrative. They pushed back on the idea that secular trends, things like GLP-1 weight loss drugs impacting alcohol consumption, or maybe cannabis substitution, are major drivers right now. They termed those relatively minor.
Okay, but wait. If 80% of consumers are worried about money, couldn't that also make them more likely to choose cheaper alternatives, maybe including cannabis instead of a premium beer? How confident can they be that those secular factors are truly minor?
That's exactly the tension you, as an observer, need to watch. I mean, they acknowledge the possibility, sure. If someone's financially squeezed, maybe they make different choices. But management insists the current data isn't showing that as the primary driver. They're betting heavily on a consumer rebound.
But they're not just betting, they're also hedging, right? You mentioned operational control.
Exactly. Which brings us to their safety net, the restructuring plan.
Right. Tell us about that.
They announced they're doing a comprehensive restructuring review. The target is to find about $200 million in annual savings by fiscal year 2028.
Okay, so that's the cushion. If volumes stay weak for longer than they expect, that $200 million in savings could help protect their profitability.
Precisely. It becomes this high leverage buffer, especially for those really strong beer operating margins, which are typically up near, 40%? It's critical protection.
And despite all this pressure, they're saying the brands themselves are holding up.
Yeah, brand health metrics apparently look good. They said brand loyalty is actually up for Corona in the general market and up for Modelo among Hispanic consumers.
Interesting. And they mentioned something about Gen Z, too.
Right. Future-proofing, kind of. They claim their portfolio has twice the market share among Gen Z consumers compared to the industry average. So they feel well positioned for the next generation of drinkers.
Okay, so if the brands are healthy, you protect that. Does that mean they're keeping the marketing dollars flowing?
Absolutely. Management was very clear they're not pulling back on marketing spend. They're sticking with the big, expensive stuff, Corona in the MLB playoffs, Modelo sponsoring the NFL, college football. Protecting that long-term brand equity is paramount for them.
But keeping that spending high, while volumes are down and they have fixed costs, that's got to squeeze margins, right? What's the financial hit?
It does. The beer margin profile, they said, faces about 160 basis points of headwinds just in the second half of this fiscal year.
Okay, break that down. 160 basis points. Where's that coming from?
About 100 basis points are from fixed cost deleverage. Fixed costs hurt more when volumes fall, plus some incremental tariffs. The other 60 basis points, that's basically the cost of sustaining that high marketing spend.
And the tariffs alone are significant.
Yeah, expected to cost the beer business about $70 million this year, so not insignificant.
Okay, so if consumers are tightening their belts, how are they actually adjusting the products on the shelf? Are they doing anything for the value-conscious shopper?
Yeah, they talked a lot about what they call price pack architecture, basically making sure they have the right product at the right price point.
So like having smaller packs or different formats available.
Exactly. Everything from maybe a premium 12-pack with good margins down to a more affordable single can. The idea is to capture that shopper who's feeling squeezed but still wants the brand they like. They specifically mentioned tweaking the positioning for Modelo Oro and Modelo Premier, maybe making them slightly more accessible from a price standpoint to compete in that high-end light beer space where value matters.
Got it. Okay, before we jump to the trade idea, let's quickly cover those other 2 points, the weak shipment number and wine and spirits.
Right. Wine and spirits, it's actually doing okay, relatively speaking, beating the market for 6 months straight, they said. Specific brands like Unshackled doing well, up 11%.
And margins there.
Expected to improve in the second half. A lot of that is just seasonality. More sales happen later in the year, plus they have profitable vintage releases in their direct-to-consumer channel then, too.
Okay. And that really big Q2 shipment dip, down 8.7%. Was that a sign of distributors getting overloaded or pushing back?
Management framed it differently. They called it a proactive inventory rebalance. Basically, good operational management.
Really?
Meaning they saw consumer takeaway was softer than expected over the summer. So instead of letting inventory build up at distributors and dealing with it later, they deliberately shipped less in Q2 to get things back in line.
Pulled the pain forward, so to speak.
Exactly. They said distributor inventory levels are now in a good spot, and they expect shipments and depletions, what goes out the door versus what consumers buy, to track pretty closely for the rest of the year. So a planned adjustment, not necessarily a crisis.
Okay. Let's move to our This Is Not Financial Advice segment. The stock, as you said, has been hammered this year, down around 42% year to date. Clearly, the market is skeptical about this volume recovery story.
Very skeptical. Management is making a huge bet that this is cyclical. So how do you maybe play that divergence?
What's the outrageous but plausible pitch?
Well, look, the current stock price is way below where most analysts think it should be. You see targets mostly in the $160, $175 range. If management is right about the cyclical bounce back, there's a lot of potential for the stock to snap back right, mean reversion.
Makes sense. So the pitch is?
An out-of-the-money bullish call spread on STZ.
Okay. Explain that simply for listeners who might not trade options every day.
Sure. It's basically a way to make a leveraged bet on the stock going up, but with a defined limited risk. You're buying one call option strike and selling another higher strike call option. It lowers your cost compared to just buying a call outright.
And the rationale here. Why this specific trade?
You're betting that the floor is basically in, supported by that maintained comparable EPS guidance. Then any positive news, any sign that consumer confidence is improving, that the macro picture is thawing, could trigger a really sharp, fast move upwards towards those analyst targets.
So you capture that upside velocity.
Exactly. It plays on both the potential cyclical rebound and the benefit they'll get from that operational discipline kicking in, especially the $200 million in cost savings they're promising, which really helps leverage profits if volumes recover, even modestly, in FY27 and beyond. It's a bet on management's execution and their cyclical view proving correct.
Excellent breakdown. Okay, so let's wrap up our deep dive. Constellation Brands delivered a strong execution beat this quarter, held the line on comparable EPS guidance.
Based on this real confidence that the volume weakness is just temporary, tied to the economy, socioeconomic factors.
And they're backing that confidence with serious money, sticking with the big CapEx plan, keeping marketing spend high.
While also creating that $200 million cost-saving safety net, just in case things stay tough longer than they hope.
So the final provocative thought for you, the listener, to chew on.
I think it's this. Management is spending on building factories, on advertising, like they know the volume growth is coming back, it's just delayed. The absolute key question to track is whether that $200 million in annual savings they promised by FY28 actually shows up, and shows up fast enough to protect those really juicy beer margins if consumer sentiment stays, well, depressed for longer than they anticipate.
Right. That savings plan is the insurance policy on their big cyclical bet.
Exactly. Which risk is bigger right now? The cyclical downturn or a potential underlying structural shift in drinking habits? That's the puzzle you need to keep trying to piece together.